It is Thursday, March the 24th, and good news is that last week we saw some real positive numbers in markets.
I saw a report that we just finished on the radio that from in the last month, and I pulled up some accounts that on average the S&P has been up around 4%, and I just pulled a lot of clients' reports up looking at just 30-day numbers, and in 30 days I'm seeing a step up in account balance.
That's the good news.
Yes.
The bad news is I would not be surprised to see some more bad news coming our way and causing markets to react negatively.
Oh, we're going to be up and down.
We are, and so we'll relish this moment, but know that there probably is some harsher weather coming.
But I still feel very positive in that in the reviews in which we're doing and in the accounts we're looking at and watching. We know where the stock market has been since the first year. It's lost in excess of double-digit return. Overall portfolios on average for those clients that are in the 60-40 range, and that's where the majority of our clients are. And again, the majority of our clients, y'all, are carrying about a 20% value in cash. We are not seeing near that decline in your portfolio, and we're really pleased with that because optimistic when things turn around, we're going to be in a quick position to recover, and we feel confident about that.
And as we've been talking to you, not only through these videos, but in our reviews, we are seeing a rotation in our portfolios towards value, which is part of the reason why your portfolios are hanging on so well, is that we've removed a lot of the risk from growth-oriented assets. So we feel comfortable with that rotation. We feel comfortable with having the cash that we have on the sideline. And that cash is really a counterbalance to bonds because we're seeing such negativity in bonds. Why invest in something that is going to lose money in this period of time versus at least getting a positive return on money market accounts?
We shared a piece of information on our radio show. If you didn't get to hear it, is that we came across a index that measures the aggregate bond inflow and outflow. And since the first of the year, there has been, since 1980, I believe it said it was, that the largest outflow of bonds to a cash position because of exactly duration and in interest rates, in the correlation between value and interest rates. Well, we kind of patted ourselves on the back in because in January we did that. So we're being proactive for you. We're really looking at different positions. EJ and Liz are all the time looking at different things we're asking to, and then we're talking to outside sources and bringing in what are the alternatives, what are options, what can we make money, and what can we do to help protect assets, and we're being very proactive.
So what we're trying to accomplish in portfolios until we think we get beyond the midterms is to take roller coaster rides out of your portfolio. We may have some rolling hills, but we're not going to have these huge peaks and valleys like riding a roller coaster. So that's what our efforts have been, and I think so far we're seeing some real benefits for taking risk off the table.
Still believing by the end of the year, going into the next year, the market is going to be up, the projection's up. Now, always events, world geopolitical events can change that, and we would have to adjust. But again, looking for opportunities, taking advantage of opportunities, but being cautious as we do it is the mantra of what we do each and every day here now for you.
That's right. So always remember,
it is your money.
And your money matters.
See you next week.